Guys, in today's video, we have ruled out 5 pillars that are essential for success in dividend investing. These 5 pillars are the backbone of dividend investing and tested by successful legendary investors. So, if you are ready to know about this, click the subscribe button and smash the notification bell for our latest video updates. So, here are 5 secrets to successful dividend investing. Dividend investing is very famous with different kind of investors, but it is more favorable with older investors, most of them who are looking for a reliable stream of income to fund their golden years. The best dividend stocks can pay a substantial dividend and grow it over time too. And with inflation now, it may be a significant best period for dividend stocks. Dividend paying stocks tend to be more defensive and outperform growth stocks in periods of high inflation, high interest rates, and economic uncertainty as per experts' opinion. But how can you best take advantage of dividend stocks? Top investors use many tricks to get most out of them. But in this video, there are some secrets to successfully investing in dividend stocks. So, here are the top tips for investing in dividend stocks. The 5 tips below are both things to do and things to avoid. In investing, it's often just as important to avoid doing unwise things as it is actively to do smart things. So the first tip is to find sustainable dividends. Finding a sustainable dividend is one of the surest ways to avoid loss, which is considered as the best rule of legendary investors. When it comes to dividend investing, one of the best ways to avoid loss is to look for a company that can sustain its payout even if business declines in the short term. So why is the sustainable dividend so vital to an investment? If investors think that a company has an unsustainable dividend, they will push down the stock price in anticipation of a dividend cut. One quick check on whether a dividend may be sustainable is to see what percent of the company's profit goes to pay the dividend. Companies that pay less than 50% of the profit out as dividends are more likely to weather a downturn in the business without cutting. Still, some companies can safely pay out more cash flow without much trouble. Investors can also check out stocks to see which companies have long-term track records of maintaining and growing their payouts. So, coming to now second tip, that is reinvest those dividends. Getting a cash payout from your stock is valuable, but if you spend that cash, you won't be able to take advantage of the compounding effect of reinvesting your dividends. Reinvesting your dividends can give you a portfolio, a needed boost, and supercharge your investment gains. Since the 1930s, more than 40% of the returns of S&P 500 can be attributed to dividend income according to experts. They also says that dividends play a particularly important role when the market returns are low. Dividend income tends to cushion the price volatility of stocks and therefore diminish overall volatility in a portfolio. Many brokerages will reinvest your dividends automatically if you instruct them to do so, and they will even buy fractional shares so you can put all that money to work immediately. Then, when the next dividend is paid, you will make even more money on your payout. At its best, you will create a virtuous circle in which your wealth continues to compound with each quarterly payout. It's worth noting that dividends are taxable even if you reinvest them. So, dividend reinvestment may work best inside tax advantage accounts such as IRA or 401k. So, inside these accounts, you won't owe taxes immediately. Coming to the third tip, that is to avoid the highest yields. When you are looking at lists of the market's top yielding dividend stocks, it can be tempting to pick the ones with the highest dividends. After all, that would seem to be the quickest way to compound your money. But often those high yields are dangerous. They are a sign that the market does not trust dividend sustainability, and so the market pushes the stock price down to compensate. Buying the highest yields can be damaging as many times these high yields are temporary and may be made up of one-time distributions that increase the yield temporarily. This type of securities tend to be extremely high in price volatility as well. So unless you are an expert at analyzing investments, it's best to avoid the market high yielding stocks. If you buy the highest yields, you could quickly lose much more money than you would have ever earned with that tempting. So, this brings us to the fourth tip, that is to look for the dividend growth. Dividend growth is far more important than dividend yield. Many investors get caught up in looking at the stock's current high yields and fail to consider how much a company can grow its payout over time. But a growing payout will help you diminish the effects of rising costs on your portfolio, and that's crucial if you are investing for decades. Don't forget that inflation data in good dividend portfolio should keep up with the average annual increase in the cost of goods. Investors can run a few checks on the company to see what its dividend growth might look like in coming years. Dividend payout ratio. This is the ratio of dividends to total profits. The lower the figure, the more the company could raise its dividend safely. Dividend growth rate. This is how quickly the company has raised its dividend in the past. High growth may signal that a management is willing to pay shareholders more. Earnings growth rate. A company that continues to grow its earnings will have more capacity to grow its dividend too. For example, a company that grows its earnings at 10% annually could potentially also grow a dividend sustainably at that rate. If a company can generate strong and sustainable free cash flow from operations, then there is a greater likelihood that the company will be able to grow its dividend and continue to deliver strong returns to shareholders over time. Coming to the last tip, that is to buy and hold for the long term. If you are really looking to turn your portfolio into a dividend dynamo, then you are going to need to invest for the long term. That means finding a solid dividend payer and then sticking with it over time. That time element is absolutely crucial, but it's easy to get tripped up when the bad news hits. Look at the experience of the Warren Buffett and his purchase of Coca-Cola stock at his holding company Berkshire Hathaway. Berkshire purchased 400 million shares of drink company for about $1.3 billion nearly 3 decades ago. The stock has risen, of course, and is worth about $25 billion as of June 2022. Coca-Cola pays about a 3% dividend yield today. Not especially high, but Berkshire yield on its investment is enormous. And that's the power of dividend investing with a buy and hold strategy. So the bottom line is, all too often many people think of dividend investing as a province of expert investors. But dividend investing can be one of the most stable and lucrative forms of investing. Use these 5 secrets above to improve your dividend investing strategy, and remember to always think long term.